Okay, what's up everyone? Welcome back to the Price Action Labs YouTube channel. So in this video, I'm going to be going over a long setup that I took on ES on the 24th of February. But before we go to the 15-minute time frame, I'm just going to start off with the 4-hour time frame because I've had a few questions about how I find my daily bias and how I find my key levels. This is how I do it. Right, so on the 4-hour time frame, you can see we have it marked up. And so on the 4-hour time frame, I'm looking at the structural highs and structural lows. Now, if we just go over to the left a little bit, we can see structural high, structural low, and then high, and then low. This is what I call the 4-pillar approach because there are 4 sections or there are 4 pillars to understanding higher time frame bias, right? And this plays into how I traded on the 24th. So the first thing we're looking for is we want to see market structure. Now, market structure is basically the highs and lows. Now, the highs and lows are what sets the tone, especially for the higher time frame. Now, after step 1, we want to identify our dealing range. So I've had some questions recently in my own community as well about what the dealing range actually is. The dealing range simply comes down to the most recent high and the most recent low. So this is the most recent high and this is the most recent low. Now, once you have the most recent high and you have the most recent low, you are then looking for your premium and discount. And so how do we do premium and discount? We project the fib from the high down to the low, right? So this is now step 3. And the third step is actually quite important because step 3 and step 4 often go together, right? So this is going to be step 3. So we want to know our PD array or where the premium and discount zones are. For those who don't understand, this is super simple. So this is the 50%. Anything above is a premium. Anything below is a discount. And so for step 4 on the S&P 500 or ES futures, we're looking for fair value gaps. Now, specifically, how do I find my key levels or how do I find my POIs, right? So the way that I do that is I find a fair value gap on the 4-hour time frame like this, right? So this is a 4-hour fair value gap. I choose the candle before the fair value gap, right? This is my POI. We see multiple taps of this POI. So this is a demand zone as we're in the discount, right? We're below that 50% area. So this is one POI. Now the other POI, now this is what's interesting for today, right? So today is longs on the 24th. What was happening is we were in a higher time frame discount, right? We were below that 50%, right? And we're targeting, so we've tapped into one POI, right? Our target is now the next POI. And so that's how simple trading can be, right? So, well, from a higher time frame perspective, the reason we were bullish, right, from a higher time frame perspective is that we were in the discount. And so once you have the discount, right, the next thing you're looking for is those fair value gaps. And these fair value gaps link to the key levels. So this is a key level, and this is a key level here for the same sort of reason, right? Because price has left a fair value gap just over here, and price has left another huge fair value gap here. And we know what the market does is it fills fair value gaps before dropping, right? Or it fills fair value gaps before rising. So now that we do expect this fair value gap to be hit at some point, right? This is how I use the higher time frames to to kind of piece together my analysis, right? So this is the order that I use. So just going to bring things over here. We have structure, dealing range, PD arrays, and fair value gaps. Those are the 4 steps on the higher time frames. Now, the good thing is once you have your higher time frame analysis down, right, the 15-minute time frame is actually the same. So what we can see on the 15-minute time frame is we are in the discount, right? We are below the 50%. Right, so this is where the PD array actually is, right? So we are below the 50%. This is the discount. So the longs from Tuesday the 24th were actually from this key level here, or this absorption area number 2, and we were targeting essentially number 3 and then 4, right? This is how the trade actually played out. So let's break down how I took the trade and why I took the trade, right? So this trade specifically on ES, if I just bring up the Discord over here, so the actual trade itself, so executions at 68.62, and this was a trailed stop, but I had stops at around 68.50, and so we're risking, made about 931 for the day. All right, so we're just going to be breaking down this entire execution, why I took the trade. Now, before we do that, let's just do a bar replay, and let's understand the market. All right, so this is the market now, right? Here is the market at, this is now 9:15 on the 15-minute time frame ES futures, right? ES futures or S&P 500 futures on the 15-minute time frame. This is what my charts look like, right? So these are my 3 levels. And so I have 3 key levels marked out before the market even opens. So I've got key level 3, 2, and 1. And so the game plan is pretty simple, right? So going into the pre-market session, what is it that I'm anticipating, right? There's a few things I look for before the market even opens, right? So there's a couple of things. Let's break it down. So the first thing is I have my power of 3 tool just for reference. So what this shows us is that this is the weekly candle and the weekly opening price was all the way up here. Now, what this means specifically is when the weekly opening price is much higher, we have a bearish week, right? So what we can see here is we can see the market is significantly below this weekly opening price. And so we have these 3 levels like this. So what does that mean? So when price is below the weekly opening price, we typically want to be looking for longs, right? This is just a confluence. This is not something I do every single time because yesterday or Monday the 23rd, I took a short that was below the weekly opening price. So I'm going to go through why, right? What criteria you need to put in place. But before the session begins, I want to understand where we are contextually, right? Are we above the weekly opening price? Are we below, right? So going into pre-market session, we had a lot of different things to indicate longs, right? So the 2 main things specifically was we were below the weekly opening price. And the second thing is we were in discount. Now, these are the 2 things which kind of derive our sort of overall higher time frame narrative, right? So we're below the weekly opening price, we're in the discount, we're below the 50% area. Now, we obviously want to tap into one of these 3 key levels, so 3, 2, or 1. Now, when we look for market open, what we're looking for specifically is something like this. So this is the first 15 minutes. So I never trade the first 15 minutes. I allow the first 15 minutes to dictate the overall direction of the market. So if we go to the pre-market plan, which is here in the VIP. So if we just take a look at the pre-market plan for this day, right? What we saw specifically from a pre-market perspective was this. So this was me posting at around 8:37 Eastern or just before 9 a.m. Eastern. So what I'm saying to traders is I've got my 3 levels, 1, 2, 3. We're below the weekly opening price. I wanted to see longs from key level 2 or key level 3. Now, I'm going to start off by looking at key level 1, right? Why was key level 1 interesting to me, right? So I found key level 1 very interesting. So how do I trade on the lower time frames? In fact, no. Before I go on to that, I'm going to answer everyone's question, which is how do I find these levels? So basically, a key level comes down to 2 things. What you're looking for is a 15-minute fair value gap. That's the first thing. If I spell that right. We're looking for a 15-minute fair value gap, and we're looking for absorption areas, right? Absorption areas. So typically, these are levels that have given us good reactions in the past, right? So you're finding a 15-minute fair value gap, and you're finding areas that have given us good reactions in the past. Now, the word or phrase good reaction is quite, I guess, misunderstood, right? Because there could be, February was very difficult, but when you're looking at these key levels, you're looking for a fair value gap that's been created in the past. And if, if that price, or if that level has given a good reaction, you're just looking to extend the zone to the right, right? So you want to see the market being extended to the right. This is what you're looking for. Now, specifically, if you look here at this level, I won't go through how I found all 3, but we're looking for levels that have held in the past, right? This is what we're looking for. Now, from a lower time frame perspective, let's start to break this one down because this is quite interesting. So the first 15 minutes of the market, I don't trade. Now, that is the key level. That is sort of 9:30 to 9:45 Eastern. So now once we've broken out of this 15-minute range, this is what we're looking for. Now, again, from a pre-market perspective, here's what we have. So we're waiting, right? We don't trade the first 5 minutes or even the first 15 minutes, right? We don't trade them. What we're looking for is we want to see how the market was reacting off our key levels. And so we're going to break this down first. So this was ES 6830. So this was a 6830 level. So that was here, 6830. Now, what do we see over here? So this was key level number 1, right? So we're interested. This was key level 1. What was going on here, right? So let's get them up side by side so traders can understand this. Now, we've been through this. I've been through this on the channel a lot of times, right? But this rejection of key level 1 was here. Now, what is this, right? What does this actually represent, right? What does the footprint charts tell us? So now, when it comes to understanding footprint charts, we have the bid, right? And we have the ask. These are the only two numbers you need to understand. Now, when we look here specifically, we have the bid, which is actually aggressive sellers, right, versus aggressive buyers. This is what you're looking at with footprint charts. Now, when you see aggressive sellers versus aggressive buyers, what happens is this, right? The footprint charts will give you something called the delta. Now, the delta is just the right number minus the left number. Now, more specifically, what we see here is a negative delta or a red delta, right? We see this red delta, right? So what does the red delta translate to, right? We see the red delta here. What does this red delta translate to? So this wick rejection before the market rallied much higher, we see a lot of red. So what does this red delta actually indicate, right? Without actually reading the numbers. Well, what it tells us is that there are more aggressive sellers, right? So there are more aggressive sellers than buyers, right? More aggressive sellers than aggressive buyers. Now, you want to look at that. You want to ask yourself something. If there were more aggressive buyers and the market moved higher, right? Who was in control at this zone, right? Who was in control between the buyers and the sellers, right? Who was in control? Who was in control, right? Well, the answer is buyers. Now, more specifically, we call these passive buyers. Passive buyers, right? Passive buyers are basically what's driving price up at this zone, right? Passive buyers, right? Passive buyers. So understanding this basic logic can really help you on the footprint chart. So think about this through. You have the bid and the ask, which give you the aggressive sellers and the aggressive buyers. Now, when you see red delta, there are more aggressive sellers than buyers, right? So who is in control? Well, it's not the sellers, because if the sellers here were successful, they would have drove price down. But the fact that price went up, it shows you that the passive buyers are really in control, right? The passive buyers being in control is what makes us understand that the market is actually bullish, right? This is what makes the market bullish, right? Nothing else. Nothing else. Nothing else makes the market bullish the way this does. So now we're looking at key level 1 and key level 2. So if this is 1, this is 2. We're looking to take a trade off, and this is 3. We're looking to take a trade off ideally 2 or 3. Which is exactly what happened here. So what is the theory behind this, right? How did I know price was going to go up, right? What was the main sort of theory over here? So candle by candle, we're going to break this down. So let's break this one down. So executions for this day were, here we go. So executions were 68, 62, or technically 63, let's say, right? And this was the execution at the key level. So here was the footprint charts, and we're going to get the footprint charts side by side with the candlestick chart. So let's break this down. So our first entry into the zone was here, right? So let's make this a bit bigger so we can see. This blue box is the key level. Now, specifically, what do we see over here, right? What is this, right? Well, it looks like a lot of numbers, but reading order flow is simple to understand when you can execute basic concepts, right? When you understand the footprint charts, they're very easy to read. So what we can see here again is negative delta like we went through before, right? So this corresponds to this candle, right? Sorry, here we go. So this chart here, right, this right-hand side is the same as the left-hand side, right? So you want to really dissect this, right? You want to sort of understand what's going on. This candle, huge bearish candle, huge amounts of negative delta or aggressive selling. Now, specifically on the bottom, it's a bit small, but when we dive into the price action, it says 316 for 101, just over here. Right? Then we see 62 for 0, 4 for 0, 19 for 0. We see all these zeros here, right? But what's important to understand is that there are aggressive sellers, a heavy amount of aggressive selling, but the market broke higher. So when I'm executing, I get a lot of questions about how I find my levels and how I execute, right? So I'm going to break down the execution now. Now, when it comes to levels, again, it was 3, it was 2, it was 1. So I'm only looking for a break and retest off one of these levels. That's all I'm looking for. I'm not looking to trade anywhere else. I have a strict rule. I do not trade in between levels, right? I only trade at levels, right? That's the first thing. So get good at finding levels. The second thing is when price comes into your levels, and you can apply this to almost any strategy, support, resistance, trend lines, even EMA crossovers, VWAP bounces, just about anything you name. If you can add and integrate order flow into your analysis, you are going to become a more accurate trader because you understand the executions. Now, this we've kind of dissected this candle over here, so we understand what was going on here. So I'll put it in red just so people can see that. So I'll put this in red. All right. So this candle here is in red. So what's really going on, right? If we break down one of the rows, we saw 316 for 101. So what does that mean? What this means is that there are a lot more aggressive sellers than aggressive buyers, but we broke above the zone. So what does that tell you about this zone? Key level 2, right? Is this a demand zone or a supply zone? That's what you want to ask yourself. Well, it's a demand zone because what's going on here specifically is this. There are actually more aggressive sellers than buyers. Now, what this means specifically in this case, right, is that the aggressive sellers were absorbed. And this is what I mean by absorption, right? This is the absorption process, right? Price comes into your level, price breaks above your level, despite there being a lot more aggressive sellers than buyers. And we see that throughout the entire candle, right? We see all the aggressive sellers here, but they don't get rewarded. Even here, we see this green candle. But what's important is the market's broken higher, but there's a ton of aggressive selling down here. Right, this little green candle, which is this little green candle here. So from an execution perspective, what I'm looking for in real time, right, how I'm looking at the order flow in real time. So if I'm executing at 68, let's call that 68.63, right? 68.63 was the execution. So when we look at 68.63 as the execution, it's going to look something like this. 68.63, I was happy to have my stop below this wick over here. And my first target was up to this high, but I was going for about a 1 to 2 on this trade, right? There was room for it to breathe or room for it to travel. The reason why I say that is because the weekly opening price, like we discussed at the start, the weekly opening price was here. So we're in discount, right? And we're below the weekly opening price. Notice how all the concepts are starting to align together, right? So we want to be trading with multiple confluences in our direction. Now, if you just take a look at this, right? So from an order flow perspective, right, we've understood that there are more aggressive sellers, right? So there are more aggressive sellers than buyers, but they get absorbed. Now, how do I know they're getting absorbed and where do I pull the trigger? This is another question I get, right? Where do I pull the trigger in the markets, right? What gives me the confirmation to go long? Now, the truth is, when you're executing, there's no perfect candle which will give you the confirmation, right? It's up to you to pull the trigger whenever you want. So I have a few rules to make this a little bit easier for myself. Right. So now I'm looking for a break above the zone like this, right? So I want to see the market breaking above. So I've seen this, right? And I will draw a break line like this, right? Just candle by candle, I will draw a break line. Now, in order for me to go long, right? In order for me to go long, I want to see the market getting above this break line, just like this. So my execution came a little bit late. It came at 63, which is fine. A couple of points above. Had my stops below the zone. Now, for me, this is enough confirmation, right? This, for me, is enough confirmation because I have read the order flow from this entire region here. This entire region in red, right? I've read the confirmation here. Where we go. So here, and then also here. So I've understood what's going on. Aggressive selling, break higher, right? Aggressive selling, again, break higher. So my execution was where this little triangle was, and this was at 68.63. Again, what kept me in the trade was this absorption over here. So we had massive aggressive selling, but the market broke higher. So we're seeing the absorption of sellers, which confirms the move. Right, so for me, I am happy to go long at this point, and this is my entire trade. This is literally how I trade, right? Literally. So what we do is there's 3 steps to it. We wait for a 15-minute range or a 15-minute range break, right? We wait for price to come into a key level or an absorption area, and then we use order flow to confirm the move. These are the 3 steps that I follow, right? These are the only 3 steps that I follow, right? Broadly speaking, right? Obviously, I have other concepts that I follow, but generally speaking, this is the way that I trade, right? I wait for the first 15 minutes, right? I then wait for price to tap into a key level. So we came into level 2, and then I use order flow to confirm the move. And so this trade came at around 6 past 10, and I was out at 29 past 10. And that is literally the way that I trade. That is the whole strategy broken down, right? That is the whole strategy. And you can use this strategy to trade however you like, right? Within reason, right? Once you have your support resistance areas, you want to be trading. So just to break things down one more time, just analyzing this as I talk. So what do I think is going to happen is I think this, right? So I think that we're going to see price come into this 4-hour zone, fill this fair value gap. And so I am bullish at the time of recording, right? I am bullish at the time of recording. So what I see here, a couple of scenarios going into the next day is this, right? If we come back into the discount, I will want to see price come into either 2 or bounce higher, or 1 or bounce higher, right? Or alternatively, we have a level at 4. We can take a long at 4 and we can target 5. This is the way you want to be approaching the markets, right? You want to approach the markets from having key levels, a systematic higher time frame bias process, and then just following the market based on the order flow.